where they're trying to break out and they're just not able to do so. Okay, everybody, we have a lot to go over. We're going to start here with Tesla. Tesla came out right after the close in perfect Musk fashion and said, hey, I understand the stock's down, but good news, we're going to split it. They're going to do a 3-for-1 split. Now, this is very gimmicky, to say the least, that they're going to announce it right now. And they're doing it to prop their stock up. A lot of companies have tried this already, and we're going to talk about this in a moment and where I think it's going. But a couple companies have tried this already. Google, that didn't work out so well, right? Amazon, that split, that didn't work out so long. This is from a trade that we did recently where we tried to buy this breakout and then got rejected, got stopped out. That was the end of it. Let me just clean this up a little bit. But what you're seeing is you're just seeing this pattern everywhere where they're trying to break out and they're just not able to do so. Saw it with Chop as well. That didn't go so well either. So this is just really very gimmicky, and quite frankly, I don't think it's really good for the company. Now, I am actually, caveat, I am already short this, and I'm playing around with it a little bit after hours, hedging it while I'm doing this. This video is being recorded on Friday night around 6:45. So this portion of it anyway. So sometimes I record different portions at different times just because I use different softwares. Okay, so what we're going to see here is this is your range. All right, this is the range that you've been in, and everybody knows this, that I like looking at these 15-minute bars, and so far you've done nothing. Now, we'll see how this pushes into the 8 o'clock hour, but I would watch this on Monday morning. If we get a pop up on this because of that, I'm just going to increase my short position. So we're going to get this. Tonight's call is going to be a little different because we're going to get into CPI, what happened today. I do want to give some ideas on what you can trade next week. That'll be more towards the end, but I also really want to go over the SPY and what happened. And why you need to be very cautious here, and what signs you can use to determine where the next leg down may be. So, but in regards to this specific trade, I would really just watch this level, and I would use this very specific wedge line. So if you trade up to it, roughly 760, if it gets that goofy, that's really where you just start really just laying lumber and just start hammering it. So something to consider, but I do think that this could just be an absolute disaster and just sell down on the news because, again, it's very gimmicky, but you trapped people after hours. So you're going to see a little bit of a move. And you see the rally because people just don't want to be long or short going into the weekend. But there's nothing redeeming about this. You've broken major resistance was right here, right? Resistance, resistance, support, flip, support, and resistance, flip, right? So now you're wedged in. Now, to understand what's really going on out there, let's talk about the SPY. So the reason that I make these videos is so that people can understand what is going on, and then they can learn how to prepare themselves so that it's possible to kind of predict that something like this might happen, or at least look at indicators that could help them. This is the SPY, and you can see this move down. We all know that the S&P is a risk asset. Knowing that it is a risk asset, we know that therefore it is, quote, more risky than bonds. We're all aware of that, right? Is it more risky than high yield bonds? Some people would say yes, other people would say no. That is debatable, but what is not debatable is that they are both risk assets. This is JNK, and you can put this on any computer that you have, any charting system that you have. JNK is the Bloomberg High Yield Bond ETF. And this actually, if used correctly, can telegraph when the S&P is going to move ahead, if there's any great decline or increase. The reason behind that is the bond market always moves before the equity market. It just does. You saw it today with the 10-year bond. You're going to see it again here in a moment when I give you an example. So the first thing that you're going to look for is you're going to look for divergences. You're going to look for when the high yield bond, which is the orange line, breaks, and then subsequently you're going to look and see if that is affected anywhere in the equity chart. So the first data point we have is this trend line on the high yield that is broken right here. This is the date it breaks. The next day we come down. But you see, once you start breaking here, it starts continuing its downward decline. And you can see how the SPY followed. If you focus on this date, this is when we had that really nice run in March. See the trend line right here? Look when that trend line's actually, because that just makes it even cleaner. So when you broke right here, you can see from that break how we just had a massive decline. So once again, this trend line break, like here in January telegraphed that this move was over. Now, there are other data that you can use. There's other indicators that you can use. But the bottom line is, if you are using this data and you understand that the bond market moves before the equity market, this could have been used to your advantage. This was one that we used. Wednesday, I posted this in our trading room, and I just was very clear about it. Once we broke this, you see the line right here. Once we broke that level, I put this in the trading room. I think it was Wednesday. We started talking about it and saying, hey, high yield's breaking down. This doesn't look good. Thursday, we got our notice on it. Once we broke this level right here, we put on a short where we bought puts and we bought the SPXS. From this line on, then we just kind of carried it overnight, came in, and we're very fortunate. And the whole thing was telegraphed by none other than this high yield. What I want to point out, someone could say to me, gee, Anthony, that's great. Where were you Wednesday? That's fine. If you're interested in that, think about joining the trading room. But you're missing what I'm pointing out here. I'm saying that this is a precursor. So if this is a precursor, and we get rid of all this data, what is this telling me? If this high yield just took out a new low, it's telling me that we may test this low or break this low. Has this rolled here and then taken out a new low? Yes. Was it followed by this? Yes. Did we take out a new low here on this break? Yes. Was it followed by a new low in the equities? Yes. So obviously we're going to get a point here where exhaustion is going to kick in and we're going to go sideways and not just constantly keep rolling down. But for now, if you're not paying attention to this, if you're not paying attention to what's going on in the high yield market, you're going to have a really hard time forecasting what's going on in the equity market. So now that you know what's going on with the SPY and you understand the high yield junk bond fund, you can see how that telegraphed the move exactly as we talked about, right, earlier. And you can see how this was actually a precursor. So you can see how you could use this in the future as a precursor to the move. Now, whether you use it this time around or you use it 5 years from now, just write it down somewhere and just remember this. It's not going to go away. Okay, this was clearly telegraphed. Now, we know where the SPY is, and we know that this is taking out a low. So what does that tell you about where the S&P may go? And you really have to understand why this is all happening. This is happening because of the CPI. So let's go through these numbers very, very quickly. Core CPI, month over month, is 0.6. We were looking for 0.5. Now, core CPI it's the cost of all the goods and services minus food and energy. So that's what this number is. Minus food and energy, we were up. Now you can see that number, and now you go to core CPI year over year, which is minus food energy, 6%, we were looking for 5.9. Now, if you continue to go down the road, here you are, CPI year over year. And this is what really set us off. See this 8.6% number? Just remember that number for a moment. And now you see month over month is 1%. So what does this do for us? Well, it does a couple things. First thing you have to realize is if you take the CPI month over month and you times it by 12, right, you're going to get a number. What's that number going to be, right? That number is going to be 84. So you could take that out and go 8.4, and you can see how they multiply this versus 12, come up and roughly get this number. Now, month over month is 1% on CPI, which includes food and energy. Well, times that by 12, and you get 12%. Which means that this number is geared to actually go higher than this. Now, what's really troubling about this 8.6 number is the Fed has told us two things. One, this is transitory, which turns out to not be accurate. And two, this is a peak, which is not accurate. Now, the data that I'm showing here, I always use free sites so that you can go to these sites yourself. This is investing.com. All this information is free. You can just go there and go investing.com, economic calendar, and you can drill into it and click on all this. Again, all this data is free. What I want to point out is this. See this line right here where we came out and you can see that 8.3 actual right here, okay? And then you come further out and you see this, 8.6, which is what came out. So we were stepping up the whole time, right? And then we had one down month. And then based upon that, they said, oh, it peaked. Now we're over that peak. And you can see that right here. Now that you're over that peak, you didn't peak. And that's why everything got thrown off today. Now, if you drill into these numbers, again, this is a free site. This is bls.gov, and this breaks down every single city, and it breaks down exactly what the costs were. So it's important to kind of look at this and get an understanding of it. And really what you're looking for is you're just going on the right side here and just seeing where you are month over month, what kind of increases you're seeing. Now, just look for what stands out. So 16.9%. month over month increase in fuel oil. Okay, that's obviously not great. Motor fuel 4.1. This is month over month, the growth that you're seeing. Utility piped gas service up 8%. Okay, that's what's driving it. So if we really drill into these numbers, it's not like we're seeing huge demand. We actually did see an uptick in used car sales, which is kind of interesting in the pricing of the used car market. But out of here, there was nothing really that stood out as something that was just erroneous. You have airfares that have gone up 12%, but that's because of what we're dealing with here with jet fuel, right? So when this says fuel oil, everything is included into these numbers. So keep that in mind. That's where the issue is. The issue's, yes, food costs are up a little bit. Yes, they're up 1% every month, as we're seeing here, right, as this goes forward. But the real driver of this is what you're seeing here. Year over year, where fuel oil is up 106%, right? May, 16.9, and you can just see this over and over again, and how we just keep increasing and compounding. We understand what's going on with the S&P. We understand that we need to look at the junk bond market in order to see a precursor to what can happen to the S&P. And we need to really take a look at the 10-year. And what is that telling us? Well, this is telling us pretty clearly that we have an issue, right? So here we are at the 50 and we hold it. Then we rally, gets right to the top, tries to break out, actually hits 318 as a high today. That means 3.18%. As the yield increases, the price of bonds decrease. So now this 326, why is that marked? That's marked because of this, okay? If we flip this level, you're gonna flip a multi-year level. Now, there's a couple things about this, and I do think we're at the tail end of this, not the beginning. That does not mean that the tail end cannot be vicious, right? I wanna make that very clear. Just because I say we're at the tail end does not mean that I'm giving it all clear. It means that I think there's one, maybe two more legs down to this whole equity market, but this could be the worst part of it. And I'll walk you through what that would look like, or what it did look like last time we had it happen. But just watch this level, because if you flip this, we're gonna have a problem. Now, last time we flipped it was back here, was 93, 94, and it actually led to about a 5-year, 6-year bull market that actually took us into 2000, before 2001. The one redeeming quality for those that understand RSI is the fact that we've popped over this. Now, this is a monthly RSI with an overbought reading, meaning that people are selling bonds at too high a velocity, meaning that velocity can't possibly continue. But this is monthly, so this is going to take time to roll. This is not just going to roll on a Monday or a Tuesday. You have to give it time. So what we're doing is we're setting up a long-term plan. We're going to trade short-term, but we're understanding the long-term plan underneath of it. And by understanding the macro, the fundamentals we went over today, you have a better understanding of why things are moving the way that they are. So you understand now why the Treasury's selling up. You understand that going into June 14th, 15th, where the Fed meeting is next week, why some people are saying 75 basis points, 100 basis points. I'm not saying they're right. I'm just saying you can understand why they're saying that. Now, this number is going to be a shock to the Fed, and they might want to rip the Band-Aid off. And that's what people are seeing here. And 50 basis points is not going to rip the Band-Aid off. So people are going to be apprehensive going into early next week, and you need to understand that. What does that mean for you? Well, I would look for story stocks. That's where my focus would be. So what do I mean by story stocks? Names like CVNA, names that we've been short for a period of time, they're setting up beautifully here. Now, if you remember this one, there was a level that we were looking at right here. We can get rid of one of these lines. But like CVNA, we were talking about this level. Okay, we're below that level. So we got below this peak. That's exactly what we were looking for. I've been saying for some time, since I think we've been doing videos on this, make sure you subscribe to the channel, because what we go over here is extremely timely and you're not going to want to miss it. But I compared it to Vroom at when CVNA was at 100, and you can go look on Twitter and see the timestamps. But the reason I'm showing you this is where CVNA is going. Because CVNA is actually in worse financial shape than this company. So it's not an if, it's a when. So shorting names like CVNA, these perma shorts, I think they make a lot of sense. You have something like Peloton. When they came out and did $750 million at 8%, it was pretty clear nobody was going to buy them. The CFO left. It turns out it really is a bike with an iPad staple to it, and eventually that this is going to just crater. So these are names I'm giving you that fundamentally have something wrong with them. So being short those is not the worst idea, because what's going to happen is as funds decide to cycle through their positions to raise capital for what they want to buy, they're going to sell the weakest kinds of names. Names like DocuSign, which I tried to short today and just didn't really work out, but that is really setting up for a beautiful short. I mean, that's like a picture. It rallies up, breaks down. You have a full encompassing of about 5 weeks there on one bar. Just give yourself a lower low, and this thing's probably heading into the 40s. Numbers I give, people are always like, wow, you're really saying some of these things could get killed. Look, you had a lot of froth in this market, okay? We were talking about NIO being, go back and look. I've been talking about NIO since it broke out over here. Same thing. Some of these names will never come back. I went through this 20 years ago, and I'm just pointing that out there. And it doesn't matter what you are. Like AMD had great numbers, reaffirmed guidance again today, and it's just tech-based. So it's being sold and nobody cares. The only thing that they really care about on the long side is energy. And that's really the only space that we were in today that we played on the long side, made money. I would say to focus on these names like Oxy. You know you have a buyer in Oxy. You know that Buffett is there building an enormous position, right? We got stopped out on the trade break even, but today we were able to pick off a trade, and I'll walk you through it. But today we were able to pick off a trade. And by picking that trade off this little move right here, right, we were able to pull out 2-to-1. So risk versus return, we pulled out 2 times our risk, which is really what you're trying to do and how you should actually quantify your trades, not by how much money you made, but by units of risk. I'm going to do a whole video on that. So you might want to make sure you subscribe to the channel, and you definitely want to watch that because that's what professional traders do. They measure their performance by units of risk, not by did they get a banger or not. I don't mean to sound condescending, but that's how, if you want to do this for a living and you want to be consistent, everything that gets measured, right, can get better. Hitting a banger here and there, that's not really going to do it, right? What's going to do it is constantly pulling money out of the market. And that's really what I'm trying to get people to learn how to do. And I think I'm getting there. So when this broke out, this was an easy trade. Now, you come back out, whether you sold it or not, you know your stop's break even, so now you're not worried about it. But all these names, if you look at the names like BPT, they're all holding up decently today. Coming back, testing levels, right? Holding those levels. Every single time that this gets below that 30, it just becomes a buy. I'll link that RSI video at the end. These are the names you need to be looking at, okay? Names like Exxon. It doesn't matter what people say or what they think they're going to do. Nobody was bailing these companies out when they lost $20 billion in 2020. And now they're going to start going after them. It's not going to work because that's not the issue. It's not that they're making, quote, too much money. It's that we have a supply problem. We all know why that exists. So I really like the space. I don't see any reason why the space is not going to go lower. If they go after the SPY is going to come down even faster. For me, looking at the SPY here, I do think it's realistic now that you're going to test this level and you're going to test this low. This was a negated inverted head and shoulders, but I do think you're going to take out that low and consider that. But on the long side, I would just be looking at the super majors. These are the names that I would be buying and sitting with. Buying these on the pullbacks. I would not be worried about adding to these names on pullbacks. This is not going to go away. That was the strongest sector today. So focus on these names. Now, in regards to others, this was something that we traded today and did fairly well with. And I just want to point this out for everybody, okay? Today's the first day in a month that you're above the 50-day, all right? So where was resistance on this? This is why you leave your support and resistance lines in. Right there, SOXS. And you can see that very clearly right there. This was something that we bought, flips over this line, and now we have a winner. Whether or not you hung with it or they didn't hang with it doesn't really matter. Everybody trades differently, and you have to develop your own style. But again, I want to hammer the point home that we went over today as we bring this home. This JNK, you need to watch this. See how this took out a low? And we went through this. Okay, what has been leading the SPY? JNK, junk bonds. So there you have it. If you're interested in more specific ideas and alerts, consider joining the trading room. It's open for a short period of time right now, but I give over very specific ideas of stocks and options all day long. And there's a link up here in the top right corner, and there's also a link in the description to join and a link in the description for a preview. For those that ask too, I get a lot of questions about what trading platform I use. There's a link in the description to get a 7-day free trial from it if you want to. It's TrendSpider, and they do a fairly good job. They're decent people. So that's it. That's all I got. Everybody enjoy your weekend because it's going to be wild next week. Trade to win.